Ahoy there from Tampa Bay. My name is Carl White, and you are listening to Loan Officer Freedom. You know what I'm getting ready to say? You know what I'm getting ready to say because I say it. I've said it every episode for the last 3 years because it's true. Thanks to you, we are the number one podcast in the mortgage industry today, and I am very grateful for you for doing that. So, all right. So I've got on the line here a very dear friend of mine, somebody I work with, Mr. Owen Lee. How you doing, Owen?
I'm fantastic. Fantastic. Thanks for having me.
So, Owen, you and I have been working together for what, about 11 and a half years, 12 years, something like that. So I'm a branch manager.
Yep.
You and two partners own the company. And so I've always looked to you like we have two very unique differences in our talents. Like, so
Hmm.
I think one of the reasons why our partnership works so well, number one, we're both honest people and we're good people. I think
Yep.
that helps.
That
Uh,
helps. Absolutely.
It does help. But number two, we have different talents. And
Hmm.
your talent of like I'm a marketing guy. And sometimes
Hmm.
I take my eye off the ball of gosh, what's the word? You just help keep me grounded, I guess is a good way of saying it. Like I get all excited about
Hmm.
marketing. It's like I just want to go out and catch something, right? I'm out there, like I feel like and this is an uncool picture, but I feel like I'm walking through the forest with a gun and I'm out hunting, right? Now, first of all,
Uh-huh.
I don't own a gun and I don't hunt. Not that I have anything against either one, but I don't do either. But you, like you, yeah, you have a more of a business approach to all this, where I have a more of a marketing approach. And it is
Hmm.
you know what I'm talking about. I'm trying to convey it to the others. But anyway, so the topic that we're going to talk about this week is based off of conversations, actually several conversations you and I had in the last couple of weeks. And that our topic is who will predictably die and who will
Mm.
predictably thrive in today's market. And what we're talking about, obviously, we're not talking about somebody dying per se, but we're talking about
Right.
companies that mortgage companies that we see them, they're falling left and right. Loan
Hmm.
officers see them falling left and right. But in the same voice, Owen, we're seeing companies that are thriving, gaining market share right.
Hmm.
And we find individual loan officers. We got loan officers in our branch, your company, and other companies too that we see in the Freedom Club. That some of these cats are having their best month ever. So let's talk about those that are dying on the vine. What are they doing or not doing? And those that are thriving,
Hmm.
what are they doing or not doing? So, and we're not going to mention any company names, but so just
Right.
in Owen, we've seen some very successful companies falling here lately, right? And many
Hmm.
led by good people, right? We're not kicking somebody while they're down. That's not our style. But I think we can learn
Correct.
their experiences. Give me a couple things of some of these companies, big and small, that are dying on the vine. Any commonalities that you've seen that would be something that, hey, you want to make sure that if you're the owner of the company, make sure you're not doing this, or if you're a loan officer of a company, make sure, like, what can we be on the watch out for so we don't get blindsided?
Sure. So here's the thing, right? If you look at the life cycle of the mortgage business, say since July, or really let's back up to about March of 2021, right? I think we were about two-thirds of the way through kind of the pandemic sugar high where the Federal Reserve was buying mortgage-backed securities up to 40 billion a month. I mean, just ridiculous, right? As an industry, I heard somebody describe it once as closing 5 years worth of mortgages in just under 2 years. But that train really ran. I'll never forget, I'm Irish heritage, right? The Fed announced on St. Patrick's Day that they were going to start buying mortgage-backed securities. We're still in 15 days to slow the spread at this point in time. And it just started, right? So if you look at March, you could tell that was kind of the low water mark for interest rates. And then as you got to that summer and that fall, inflation started to pick up and the Federal Reserve announced a wind down of their purchase of mortgage-backed securities. The fact that they were going to start to raise the Fed funds rate was the worst kept secret in the financial world. They even said it. And then that kind of started this model of increasing interest rates, decreasing volume. And for a while, there were many, many companies out there that pretended like it wasn't happening. Interest rates were still relatively low, even into the first quarter of 2022. And companies were hesitant to make changes. Recruiting was still going crazy. Company owners had fat bank accounts. They acted like they were unaffected, still paying bonuses for loan officers to move from company A to company B. But that's really when it started, when companies ignored what was happening in the economy around them. They weren't looking at key, simple metrics like how many full-time employees do I have per loan closed? Or if you flipped that, how many closings am I getting per full-time employee? What is my loan officer productivity, right? Loan officers that used to close 10, 12, 14, 15 deals a month and had an assistant or two assistants were now closing 6 or 7, and they still had 2 assistants. The cost, the fixed cost per closed loan was skyrocketing, and people weren't paying attention to it. So the common denominator really amongst the companies that weren't doing well was, are you paying attention to your expenses? Are you paying attention to your decreasing volume? And are you making changes in your company based upon that information? And those changes are uncomfortable and they're hard to do. And they were especially hard to do in the beginning because so many companies in this industry were pretending that the slowdown wasn't happening. And so when you look around, continue that, everybody had fat bank accounts going into this recession. When I say everybody, I mean every mortgage company, because we had just come off of 2 years of record volume. And they started to burn through it. And they started to hope interest rates would come down. And they waited and they waited and they waited, because those are uncomfortable conversations. Hey, loan officer Sally. Hey, loan officer Bob. You have this assistant and this expense and that expense, and it's no longer working. What are we going to cut? And, you know, we're all salespeople. I'm a salesperson at heart. You know, I think of myself as selling Success Mortgage Partners right now, you know, promoting it. And when you look at that, people who are salespeople always want to sell their way out of the problem. But when interest rates are increasing and deals are becoming more scarce, that's not realistic. You have to do that and other things. So the biggest common denominator was not making the changes, not having the tough conversations. You kind of fast forward to now, this has been going on for 12 months and 18 months. And you look at what happened with the September jobs report and that came out the first week of October, and some of the CPI inflation numbers. And interest rates went up and mortgage-backed securities went up, and some companies weren't able to handle it. And so they looked at that, didn't know when it was going to end, and they folded. You know, as we sit here the day after Thanksgiving, the day that we're recording that, we have a whole fresh group of independent mortgage banks that have just gone belly up, and it's horrible to see, but it's because they haven't been disciplined about costs, doing the things that they need to do in order to survive in the mortgage economy that we're in. I'm sorry, that was a long answer to a short question, but I think it's important to go back and look at the beginning, because those companies haven't been making those decisions, or they made them too shallow and too late. They didn't have a big enough effect.
Yeah, and yeah, man, there's a lot of good stuff in there. Yeah, I think, you know, I love what you said about sometimes you can't outsell yourself out of a situation. And boy, that's a great way of putting it, because you and I both know, and we've seen somebody that was closing 50 loans a month, maybe now is closing 12 loans a month, and they kept the same team members. And
yep.
Boy, You just can't do that. And you know what? I think a big part of the problem, frankly, as sales, I think most of us are more salespeople than managers,
Mm-hmm.
right? And I think as salespeople, we tend to be like nice and warm and fuzzy and friendly and like really and love people, right? And I think that
Mm-hmm.
attracts people to a great salesperson, right? I think that's what great salespeople are, is they're just
Absolutely.
optimistic and they're just warm and fuzzy and nice and pleasant, right? That's just how it works.
Yep.
Uh, so the idea that I've got to call, and I'm using a hypothetical name here, Bob or Lisa in my office, which I have neither one working in my office, by the way. That's just hypothetical names. But if I got to call Bob and Lisa and say, hey, loans are down, and we were processing, and again, I'm just making up some numbers. We
Yep.
were processing, you know, 700 loans a month, and now we're 300 loans a month, or we were at 20 loans a month, and now we're at 8 loans a month, like whatever that number is. Um, Somebody's got to go. I mean,
Mm-hmm.
it's just how it works. Or otherwise, what happens, and we've just seen it. We're not going to mention any names again here, because these some good, great people, and some of them good friends of ours, have gone belly up. So what happens? I don't want to lay anybody off, so I don't lay anybody off, and then everybody goes out of a job because the company goes belly
Mm-hmm.
up. And in essence, they shot the goose, and you can never
Mm-hmm.
shoot the goose. And it's not a greed thing or a non-loyalty thing. It's just, if we run the business to the ground, then 100% of people end up, I say using air quotes, getting laid off. Yeah, it's just, nobody likes to talk about this stuff, but it's just a necessary element to it. And
Well, and another thing that is almost as equally hard as the headcount topics, right? How many people do you employ and how many are you going to cut? Is you really have to look at it. 2020 and 2021 was so abnormal, right? And it was all government induced. If the Federal Reserve's not buying billions and billions of dollars of mortgage-backed securities, none of that happened. But it changed the economics of our industry. And one interesting thing is, so you had underwriters making, 100, 125, 150, $200,000 a year plus. Loan officer assistants, processors making 80, 90, $100,000 a year. And that's wonderful while those economic conditions exist. But when those economic conditions don't exist, and we had this little thing that all salespeople have been fighting, and all people in the mortgage industry have been fighting, called margin compression. When margins get compressed, there's no more room for underwriters to make 125, 150, $200,000 a year. There isn't room for processors and loan officer assistants, or to make 80, 90, 100, $110,000 a year if their job does not contain some aspect of finding new borrowers, right? And you go back to really what the economics of the industry were prior to March of 2020, and you because your loans, the hardest part about the last 18 months for independent mortgage banks was not just that I'm selling less loans, it's that I'm making less money on the loans I'm selling. So it's a two-pronged problem. And so that was the hardest part. And so it's also going back to all of those people and saying, hey, I know your base salary is $130,000 a year, but it really needs to be 90. And that, for our company, we had to do some of that. That was almost as difficult, if not more difficult, than headcounts.
yeah, yeah. And I've always thought, from the assistant or the processor that might be listening to this, just make sure you're the best one at the company, and that
Yeah.
we're always going to have a processor. We always have to have an underwriter. We always have to have a closer. But we might not need 10. We might need 9 or 8 or 7 or 15. But be the one that we can't let go. I've always thought, like, if I'm hired to be a field goal kicker, which in essence, that's kind of what I do right here for this
Yep.
company, is I'm going to be the one to be able to go out there and nail an 80-yarder every single time. So the idea
Mm-hmm.
that there's going to be a better one come up, it's just not real likely because, man, I'm out there working my leg like often, right? I go out there on the training
Right.
field and I'm kicking the football. I listen to stuff. I learn to stuff. I go to events. I hire sales trainers. I hire coaches. I hire like all kinds of people to make me a better at what I am, and I know you do the same thing. We
Yeah.
hang
Well,
and win.
I have to say, Carl, though, I don't know if it's as good of an analogy, but Carl White's not a field goal kicker. Carl's a touchdown maker. But, but anyway, but you have a great phrase, Carl. You have a great phrase. I've heard you say it several times, where you say make yourself to those processors, to those underwriters, and again, I'm not for a second skirting how difficult of an issue this is, but the best advice is make yourself indispensable to the company. You know, be exceptional at what's right in front of you. That's all any of us can do, right? I'm 100% convinced that Success Mortgage Partners is going to be the first IMB in the country to come out of this difficult market that we're in. And the way we do that is to have everybody who's on the bus concentrating on being exceptional at what's right in front of them. And if we do that, everything else will take care of itself.
Yeah, because I'm sitting here thinking, the last thing that's going to happen over here for me is for me to call up Diane saying, "Hey, Diane, man, I'm going to have to lay you out." Like I couldn't operate without her. Like the thought of her lead break out in a cold bead of sweat, or like Allison,
Oh, in our company, yeah.
a lot of things might happen, but Allison's not going anywhere, right? Or not by our choice anyway. Or
correct, yeah.
Or Madonna, same thing. Like they made
right.
it so valuable and so versatile that like no matter what happens, their job is secure.
Yeah, that the thought it's the same concept for everybody, right? Make the thought of you not being there just unfathomable to the people that you work with, right?
And I would say that goes in with the loan officers too. So like we just saw,
correct,
debating about whether to bring this up, but I think I can pull this off and make sure that everybody understands my viewpoint on this because I know it's a sticky subject. I know we were talking a couple of weeks ago when we were having our little weekly call, Owen, where there's a company, and it's probably many of them, right?
right.
Where they're clawing back bonuses that they gave to loan officers. So a couple of years ago, they wrote these check for 20,000, 50,000, 100,000, some of them $1 million for a loan officer to leave company A and come to company B, right? And come to find out, those weren't bonuses; they were loans that would be forgiven at the end of 2 years. Well, here it is, 22, 23 months, and the company is laying off the loan officers and now calling the loan what was thought to be a bonus, calling the loan due, right? And I'm not going to sit and defend the company, even though I'm sure they're fine people over there, right? But for me, I mean, the first thing when I heard that, I went, "That son of a gun company," right? I'm just being honest. And then I was thinking about it for a few minutes. I went, no, it's not son of a gun company. It's loan officer screwed up. Loan officer didn't do what he or she promised to do, and that was to close loans. They didn't prospect. They became a victim of the market instead of making sure that they focused on their marketing and go do the activity that's necessary, right? They were too busy blaming the market. No, that's the market's the reason why I slowed up. No, you slowed up because you slowed up, right? you stopped prospecting, or you slowed up prospecting, or you prospected like you did in 2020 when you didn't need to, right? You didn't
Sure.
prospect like you used to have to do back in 2012 and 13 and 14 and 15 and 6. Like, brother, we broke out, like we would bleed, from prospecting,
Yeah.
from I'm using air quotes here, knocking on doors. Our knuckles had arthritis from knocking on doors,
Well,
right?
that's right, right? It's like the difference between hunting and going out and truly having to hunt, right? Finding a blood trail, or, camouflaging yourself or whatever, versus driving your pickup down the street and having the deer jump into the back of the truck,
Yeah.
right? That's the difference of what that market was like. But if anybody wants to look that up, I know, we probably shouldn't say any company names, but there's a widely distributed Wall Street Journal article about it where you could read all about it. But yeah, they structured the bonuses as loans. A condition of the loan was that the company had the right to call it due and payable in the first 2 years or 3 years. And what they could do is they could fire the person so that they would no longer work for the company. So the company could then call the loan due and payable, and the company didn't care, right? It was and the thing about it is these companies are a lot of things. Everybody would know the names. These companies are a lot of things. Dumb is not one of them, right? So they knew that they were going to be spoken poorly of in the loan officer community for doing this. Yet they decided to do it anyway. They're not stupid. And I think more than anything, that's a commentary on where the industry is today versus where it was 2.5 years ago when these types of bonuses were being paid out. And even during that period in the summer of 2022, when there were a lot of companies acting as if the mortgage economy wasn't getting bad. There was a period of time for 2 months, 4 months, 6 months when it was obvious to everybody who was watching the numbers. But there were a lot of companies that thought it was just going to be a temporary blip, and they were going to spend that money that they had in the bank, and didn't go so well for a lot of them.
Yeah. But again, I can tell you this: nobody's called me up to say, "Hey, Carl, we want our bonus back," because I produce, right?
That's right.
I produce. I go out.
Well,
Is it?
those that are prospecting are, because there are so many people crying in their Cheerios, that those that are prospecting, those that are doing the daily success plan, those that are doing call stars, or as we call it inside of our umbrella, the circle of champions, right? Those people are doing well. And, what my old Polish grandmother used to call elbow grease, those people that are bringing the elbow grease to work every day are still doing just fine. Not 2020, although some of them are eclipsing what they were doing then, but far better than where the industry average is. Far better.
Yeah, I
So,
just do the activity, and look, if you just do the activity, all these problems go away. I mean, that's just.
mm-hmm.
I mean, that's the. And don't get me wrong, I feel for the people going through that, because man, I've been through some hard. I've been twice in my life. I've gone through a really hard time. One time, very hard, and I get it.
Mm-hmm.
I'm empathetic to the people. I just don't want to join them. And so if I don't want to join them, I have to do what they're not doing, and what they're not doing is
Yep.
prospecting. Because 100% of loan officers that I see, they're actively prospecting in a proven way with a proven plan. All of them are having success. But there's no little asterisk, like
Correct.
all of them. And those that choose not to do that, well, all bets are off.
Mm-hmm.
And
Yeah.
yeah,
It's interesting. Just one more thought about this. I kind of a different way to look at it, getting back to the company point of view, what we were talking about earlier, right? What companies are hallmarks of those that are going to survive and those that aren't. If your company has not talked to you about these things, or does not have a plan that they've made known to you, I would be worried about it. And I just give this one common example, right? I'm from Detroit. And people in Detroit always love to talk about the automobile industry, right? It's still kind of what we're known for. But if you really think about it, no company out there is big enough or rich enough to weather the market, because no company is big enough or rich enough to battle the entirety of the economy. If you think about General Motors for 1 second, from the end of the Second World War to the year 2000, about period of about 55 years, General Motors was the largest, richest corporation in the world most of those years. They made more money than anybody else, and they had more gross revenue than anybody else. They were Apple. I mean, they were Google, right? And in the late 90s, they stopped having the market share that they had. They still spent money. They pretended they were the General Motors of old. The economy had shifted. And what happened? In 2009, they went bankrupt, right? Just as any other company. A year ago, Facebook let go 15,000 employees, right? No company, not General Motors, not Facebook, certainly not Success Mortgage Partners, or any other company in the mortgage space is big enough or rich enough to ignore what's going on. And I think the biggest hallmark of when to be concerned and when not to be concerned is, does your company talk to you about this? Do they talk to you about what their plan is? Can you see, touch, taste, and feel the things that you know they should be doing? And if the answer is yes, and they're talking to you about it, you're probably in a place that they're doing the right things. If you never hear anything about it, I'd be very concerned.
Yeah, I like that. So who will predictably die and who predictably thrive? I think, the take home message we have here is don't ignore sales activities, make sure that you're still or maybe still make sure you're actively prospecting, right? And real prospecting. We're not talking about going in and liking somebody's fake Facebook post. We're talking about actual prospecting.
Yeah. Yeah.
Downsizing when necessary, although painful, downsizing might be necessary. And if we don't, then the whole thing might go away. And I think, I think right now what I'm seeing a lot of, Owen, is I see people so worried about wrong word. I find so many people emphasizing on their branding that they forget about their prospecting. And that in today's social media world, which I like social media, right? I've done well on social media, but I think I don't think we can, I think sometimes when people, they spend so much time on their branding, they forget what actual prospecting looks like. And I'm not saying branding is not important, but I'm saying prospecting, if I have to choose between one of the two, I'll choose prospecting over branding every day of the week. I like both. Prospect first and then work on branding instead of the other way around. Hey, one last thing I want to cover here.
Totally agree. And can I just say one thing about that? I totally agree. Every loan officer out there, I'm sure, that listens to this podcast, because I think the loan officers that listen to this podcast are above average for sure. I would bet a much larger percentage of them could accurately define prospecting activities as opposed to actively defining branding. Branding doesn't even have a universal definition. And of course, if you don't have borrowers, you can't brand, right? So you're really putting the cart before the horse if you worry about your brand before you worry about how many borrowers you have. So I could not agree with what you just said more. I'm not saying there isn't value in branding. There is value in being known for something, right? Which is probably the best definition of branding I could come up with anyway. But you have to have borrowers and you have to have clients. Prospecting is making your brand known in a way that involves picking up the phone and getting your face and your message in front of people. It's not, as you said, liking things and making posts on Facebook. I've come across so many mediocre loan officers who are no longer in the industry, who have other jobs right now because they couldn't feed their families, because their definition of prospecting was going on Facebook, liking other people's posts. That's not prospecting.
Hey, I think we got time to squeeze this in a little bit. I want to talk about one more thing
Yeah.
too. Um,
Hmm.
what about so we talked about downsizing. We talked about make sure you're prospecting,
Hmm.
making sure that you have the right people on your team. Uh, where does technology weave into all this? So what technology like the ones that are going to thrive instead of die? Is there any particular technology or technology trends that
Hmm.
you
Well, a couple of things. One is I think a hallmark of a company that's going to thrive is a company that's managing well enough to still be able to invest in technology. You cannot close your eyes to the future, right? We've talked a lot on this episode of the podcast about how you can't make decisions like it was 2020 and 2021, but you also can't make decisions as if 2023 is the only market you're ever going to be in. This market will turn. We're in a cyclical industry. Carl, you and I have both seen it many times. We've read this book before. We just don't know what chapter we're in, right? But you have to continue to invest in technology because the things that are going to be hallmarks of success in the future, they all involve technology. And specifically from a loan officer point of view, I think it's technologies that help put you in front of borrowers and in front of referral sources and borrowers and kind of force multiplies your message to those people in a very predictive and regular and frequent way, because the technology I think is going to change the way loan officers operate. I don't think loan officers are going to become travel agents, right? I don't think we're going to be eliminated, but I do think loan officers that learn about and adopt technologies are going to do better, and loan officers that don't are going to do worse. I have a saying around my office: if you don't adopt technology, you're going to work 30% harder to do 30% less business, because your traditional referral sources just aren't going to have as many referrals to give, because those borrowers are going to be picked off earlier and earlier in the process about people who have adopted technology.
Yeah, love it. I think that about covered it.
So
Did we miss anything?
yeah, just one other thing that I'm very, very excited about, Carl. I know that you have been working on artificial intelligence. I've been privileged enough to see it, have meetings on it, kind of play around with it a little bit with Chris Johnstone. And the thing I love about that, it fits right into the technology. A lot of people hear the buzzwords artificial intelligence and AI, and a lot of them, kind of don't know what that means, although they can go find Chat GPT and have them write a 5-paragraph essay on whatever mortgage related topic, how to explain a 2-1 buy down or whatever. And that's great. But how does it work for prospecting? Well, Carl and Chris have worked hard to come up with something that works and that you can implement tomorrow, which I think is a great, great thing. And for those of you who want to be part of the cohort of loan officers that does well on technology, I would become very, very curious about Carl and Chris's product, because that and some other predictive technologies that are out there in the marketplace, I think is the cornerstone of the folks that are going to do better.
Yeah, well, and if we could kind of have a love fest here back and forth a little bit, I believe, and this might not be true, but I think it is. In fact, I'd say I'm 98% sure that you guys are the first company that are embracing a CRM technology that is woven into artificial intelligence, where that your loan officers, when they're operating their CRM, it's using AI technologies to have conversation with the borrowers until the loan
Mm-hmm.
back in the shop and can take over that conversation. But having AI technology, having conversations with the borrowers, with the co-borrowers, with the past database, some really exciting
Mm-hmm.
stuff. So I think right now the AI, the problem with AI right now is everybody's a big word. I think a large percentage of the crowd understands this is a big deal, but
Mm-hmm.
I don't think they know how big of a deal it is. And number two, I think in essence, we've handed an iPhone to the caveman and they go, wow, this is really cool, but I don't know exactly what it is. And I think that's what we are with AI right now is we're cavemen and we just been handed an iPhone and we look and go,
Yeah.
wow, cool little pictures there. And maybe using chat GPT to do email, like a blog post or something. We have no idea what this could do. So anyway, kudos for you guys for having embracing the technology. I think it's going to be a game changer.
Well, I think it is going to be a game changer for us. It's going to be a game changer for our loan officers, and our loan officers that adopt it. And I just think if you look at these technologies, right, the ones that are going to be a winner, and I think your CRM is definitely going to be a winner, are ones that force multiply your ability to communicate faster and quicker with detailed information to the borrower, because that's what people want. I want information that's unique to me, my question, my issue, my loan, whatever, and earlier and more often in the process. If you really look at it, our company was founded and flourished, and a lot of what you do, Carl, at the Freedom Club or the Mortgage Marketing Animals or whatever, is founded upon going to real estate agents and having a system and having a daily success plan. Why did we go there? Because that's where the loans were, right? And why do you adopt technology? You adopt technology because you're going to be able to get the loans faster and quicker and more of them. You can talk to more people. You can engage earlier in the process. You can talk to more referral sources. You could answer them quicker. You can give them a better experience. You can get more 5-star reviews. All of these things fold into more business. And so the number one reason to use it is because you can get to more people faster. I don't know exactly which way technology is going to take it, but we went to the real estate agents. Specifically, we went to the buyer's agents because that's where the loans were. Now we have the ability to find some portion of those loans further upstream, right? It's like if you were I'm not a super big fisherman. I enjoy it when I have the time to do it. But if you're fishing in a stream and you're like, oh, upstream, there's a certain number of fish and nobody's fishing there yet, right? That's technology. And those people that find out about it, and the brilliance of what you've created is I can start using this tomorrow, maybe not literally tomorrow, but right next week, right away. And instead of talking about it and wondering about it, I'm riding in the front car of the train. I'm not riding on the caboose, right? Again, for those of us old enough to know what a caboose is.
A caboose, the people that sat in the back of the train,
Right.
got all the smoke from the black smoke from the coal. And so the further up you were
Right.
towards the train, the less smoke that you got. So it's that's why the first
Right.
class are in the front, not the back. It's because that old thing with the trains. Anyway, hey man, good stuff. Good episode. A lot of definitely a diverse conversation here.
Yes.
And I guess our main thing is, hey guys, the market doesn't dictate your success. Our actions or lack thereof is what dictates ourselves. Who we're hanging out with, what we're doing, the activities that we're doing the right activities, doing the loan getting activities. Man, just focus on those things and you'll do very well. And for the people going through a hard time, hey, we're not throwing rocks or kicking at them. We want to lift them up. We want to embrace them. We want to help them. We've all been through some hard times. And I know you've been through some
the greatest thing for those folks is you have the ability to change it.
Yeah.
Your actions can dictate a change. And so it's great. It's a great thing in life. And I don't want to become philosophical, but it's a great thing in life to be able to have an opportunity to come to work, change your actions, and start to do better. That's one of the things I love about the mortgage industry. If many Americans who work in different lines of work don't have that ability, but we do. It's a living, breathing opportunity that's in front of you every single day.
You go sell more loans, I'll make more money.
That's right.
Do the activity to sell more loans. That's it. Regardless of rates are up, rates are down. Somebody's closing a lot of loans today. Make you that one person. So, hey, thanks so much for listening
True.
to episode. Hey, if you want a plan, well, how do I close more of these loans? Or if you'd like to hear some more information about the how you can these CRMs that are working with artificial intelligence and helping you get even more closings, we'd love to talk to you about that too. If you go to freedomclubdemo.com, freedomclubdemo.com, we'll walk you through a plan and we'll show you how this works. And I think you'll be glad that you did, right? I think you'll be glad you did. So, hey, thanks for listening to us today. Owen, always a pleasure, brother. You're just an awesome, smart guy. And
Absolutely.
Much hanging out with you.
Thank you, Carl.
All right, gang, freedomclubdemo.com. We'll see you on the inside, and we'll also see you on the next episode of Loan Officer Freedom. Thanks again, everybody. Bye-bye.